financial literacy, and the human condition. Welcome to Financial Fitness with the Money Doctor, Dr. Francis Rahaim.
You're right.
I guess I was talking about if Jerome drops it from Jerome, like we're buddies, if Jerome dropped it from 4.25 to whatever percent he wants it dropped to 1.
To 1, yeah.
Yeah.
Yeah. So that's the idea behind it. I mean, that's the sell is, look, if I just tell the Fed to lower this interest rate, we're going to pay less in interest and everybody's going to be happy.
Right.
That's great if you're the government, not so great if you're us. Hi, it's Francis. I just wanted to take a minute to thank you for watching this video. If you're catching us on YouTube, please help us help others by clicking like, subscribe, and all notifications so you don't miss any videos. And check back for the next video. I think you're going to love it. Thanks again. For more information, you can visit us at hugyourmoney.com.
Welcome to Financial Fitness. I'm Jess Tyler, along with the Money Doctor, Dr. Francis Rahaim. Hi. What are we talking about today?
We're talking about what might be possible, understanding Trump, the Fed, and the debt.
We only have 28 minutes, right?
Yeah, well, but we're going to do this in layman's terms because really what I find is that most people have a sense for, debt bad, right?
Mm-hmm.
Money good, debt bad. Even if it's the country, we have all this debt. Isn't this awful? The national debt. What are we going to do about the debt, the debt, the debt? I wonder how many people really understand what that debt is when we're talking about it. So we're going to use some analogies today about how this might affect your household and how this is similar to what goes on in your household budget. We are talking about why President Trump is pushing so hard for big interest rate cuts and what they could really mean for your wallet. Okay.
Right. Do we want to start with the biggest question, which is if we do owe this money, which we hear about it all the time, who exactly do we owe it to? Is it China? Is it one place? Is it multiple places? And what are we going to do if that debt gets called in?
Well, let's break it down in everyday terms, right? Let's go through some key points, and I promise we will get to your question because it's a really important one. But the first thing is what's actually happening? Why are we talking about this on Financial Fitness today? And basically, President Trump wants the Federal Reserve to slash those short-term interest rates. Short-term interest rates. We're talking about rates that would affect buying a car, taking out a personal loan, something for a year. But pay attention because your long-term interest rates may move in the opposite direction. So he wants the Federal Reserve, Jerome Powell, essentially, who he's blaming for things already, and that may be part of this, to chop those rates from about 4.25%, where they are now, down to 1%. Now, that's the kind of an emergency move that the Fed would usually take during a recession or a financial meltdown. Most experts don't think we're there, at least not yet. So that's what's so disturbing is this sort of swipe of a pen. I want you to change these interest rates and drop them from 4.25 to 1%. So why does he want to drop those rates so low if we're not in an emergency situation? And I promise I'm going to let you ask that question again, but I think a little background is helpful here. I think what he's thinking, and who am I to decide what he's thinking, right? But the consensus is he wants to make it cheaper for the government. That, believe it or not, that was the United States calling me. I'm sure that's a scam phone call. Pretty sure it's a scam phone call, but that was pretty darn funny. Okay, so I think
he knows you're talking about him, Francis.
Why would I not be surprised about that? Okay. So I think what he wants to do is to make it cheaper for the government to borrow money to pay off old debts. What? We do this in our households and I complain about it, right? Borrow money to pay off old debts. All right. To try to give a slowing economy a boost. Now, what I mean by that is there are signs that the economy is slowing. And when you drop the interest rate, the rate at which people are able to borrow, right? They borrow more money and they buy more stuff.
Right.
On debt. Okay, on debt. But this is the thinking from economists in general is when you drop those interest rates, you will give a slowing economy a boost. That may be what he has in mind. But again, as far as the economists I've listened to, and research, nobody seems to think we're in this emergency situation like we were during COVID or the housing bubble. So that's what's so disturbing is why is he wanting that rate dropped so drastically right now? The other side of the coin is possibly it's a little bit personal to set up the Fed chairman, Jerome Powell, as a fall guy if things get worse. In other words,
Okay.
Trump could always say, I wanted him to drop those interest rates to 1%, and he wouldn't do it. So it's his fault. Okay.
Right.
All right. We'll talk about what the risk of that is. But your question is, if we already owe all this debt, the government owes this debt, who the heck do they owe it to, right?
Hmm.
I mean, are we like going to China going, hey, we want to buy some new missiles. Why don't you give us some money? Right?
Right. And
Okay.
also, geopolitical relations aren't so great right now between China and the US. So, does that play into it?
Jess Tyler with a geopolitical reference. I love it. What have we done to you, Jess? Okay. So mostly we owe the debt to investors. Hang in there. Okay. To investors who buy US Treasury bonds.
Okay.
Does that seem weird? Right.
Yeah.
Um, in the financial world, we talk about equity and debt, and we talk about equity are stocks, and debt are things like bonds, right? Bills. So investors that are buying those US Treasury bonds are doing it to keep themselves safe. Now, here's where
Investors, are you talking people or are you talking countries?
we are talking basically everything from your grandmother's 401k or a pension fund to foreign governments. So
Okay.
banks buy these US Treasury bonds, right? Pension
Okay.
funds buy them, insurance companies buy them, foreign governments like China and Japan buy them,
Hmm.
even the regular Americans through their regular old retirement accounts, right? Um, buy them. It's part of your diversification to try to buy some safe stuff
Okay.
along with your risky stuff. And right from the top, places do this, right? Including foreign countries. So they buy these US Treasury bonds to protect themselves. That point has to be driven home. They're buying our bonds to protect themselves from risk. Okay. Now,
Okay.
when the old bonds expire, bonds have a certain period of time. They're good for 5, 10, 20, whatever the time limit is on the bonds, right? When an old bond expires, the government pays those back by selling new ones. Now,
Okay.
I promised you analogies because this is really, if you aren't into finance, this is going to sound crazy.
Well, it
But
sounds kind of like a pyramid scheme to me. Like you're a little bit. No?
well,
Okay.
okay. But it's the way it works. It is kind of crazy and it is kind of like a pyramid scheme in a way, I guess. But think of it in terms of your own finances. It's like rolling over an old loan into a new loan with a
Hmm.
different interest rate, right? So you
Right.
have your
Okay.
mortgage at 6.5% and rates go down, right?
Yeah.
Which is what he's saying he wants to do. He wants to push those rates down. And then you're going to refinance at 3%.
Hmm.
Okay. So think of it like having a giant credit card that never really goes away.
Mm.
You pay it off, you open a new one, hopefully with a better rate, but you haven't solved the problem. You still owe the debt.
Right.
And the interest, I'll probably give the stat again, the interest on the debt that the United States owes is
Hmm.
more than $1 trillion a year.
Oh,
The interest, Jess. Now, to
yeah.
put this into perspective, the Social Security, the amount of money that we spend on Social Security is only $1.4 trillion a year.
So the
So
interest is
just,
almost as much as.
yeah. So people are talking about, will they cut Social Security? Geez, if we could just wrangle in the debt, it would be
Hmm.
great, right?
Yeah.
Okay. So I hope that answered your question about who this money is really owed to.
Hmm.
Um, but just understand that when we're talking about debt, it isn't that the United States went out and bought a bunch of stuff, uh, you know, like we would do and call it debt, but they sell those US Treasury bonds to countries and to people who want to protect themselves from risk. And in doing that, it creates a debt of
Okay.
which has an interest due on it of more than $1 trillion a year.
And it keeps growing and growing and growing every year.
And it keeps growing every year because we aren't
Hmm.
touching the principal like we would be on our own personal debts if we did something, like our system or some other way to pay down debt. Does
Okay.
does that help? I
Yeah,
hope.
it actually really does. If you,
Okay.
yes, equate it to the credit card makes sense to me.
Oh, good. Good. So what's the real risk in this, I guess, right? The
Yeah, it sounds like if
what's
you're getting a lower interest rate, you're going to get a lower payment. So that seems like initially people are happy about that.
Well, we're not making that payment, right? The government is making that payment, right? They're trying making it outward. So you're right.
I
What
guess I was talking about the if Jerome drops it from Jerome, like we're buddies. If Jerome dropped it from 4.25 to how whatever
to
percent he
one
wants it dropped to
to
one.
one, yeah,
Yeah.
yeah. Um, so that's the idea behind it. I mean, that's the sell is look, if I just tell the Fed to lower this interest rate, we're going to pay less in interest and everybody's going to be happy.
Right.
That's great if you're the government, not so great if you're us.
Okay.
Lower rates can push inflation higher.
Yeah,
That
we don't
means
want that.
it means your groceries, your gas, everything else could get a lot pricier. So,
Hmm.
when I was talking about if you just refinance your credit cards or your mortgage, yes, you might get a
Hmm.
lower interest rate. But the thing is, it doesn't solve the main problem. This is something that every president since we've had debt has had to deal with, and none of them have done it successfully so far. Really,
Hmm.
right? Some people wrangle it down a little bit, but here it is, $1 trillion a year in interest. We
Yeah.
if you scaled that down to household finance, you'd still be having a fit over the amount of interest you'd be paying.
Hmm.
So it doesn't solve the main problem. The government owes too much debt. That's it. When people are trying to buy bonds, U.S. Treasury bonds, to keep themselves safe, they're doing it as a hedge, right? They're doing it to protect themselves from risk.
Hmm.
Do you want to buy a bond from somebody who's overloaded with debt and can barely pay the interest payments or maybe not make the interest payments?
So that means that people are going to slow down wanting to buy those bonds.
It means a lot of things. It means our rates to borrow money from other places is going to go up
Oh,
because, right? Because we look riskier.
yeah.
So, yeah, so it's a creepy situation to be in. Um, I think that we obviously we'll have to talk more about this in the second half, but um, I guess I just want to hit one more thing before we go to break, which is how much will Trump's tariffs actually harm us, right?
Yeah, I
I
think
mean,
that's the thing most people want to know. It sounds good in theory. Um, the tariffs making other countries pay more until you realize that means we're going to pay more.
yeah, there's so many things to I hate to use this term unpack because everybody uses it, but there's so many things to unfold and go over here. And I just want to make sure that we're doing them in sort of layman's terms, which is why we're talking about what that debt actually is, that it's U.S.
Hmm.
Treasury bonds, right? But, you know, we can only guess about the tariffs because the news keeps changing all the time. But
Right.
economists estimate that the tariffs could raise the inflation by about a percentage point. So if it's at 2.4 now, that means if the tariffs could bump it up to maybe 3.4, 3.5 over time, that means you're paying out 3.5% more on everything you're buying.
Mm.
Yet
Is
the
there a
job
rate
market is weakening. Go ahead.
is there a rate that inflation gets up to that then you call it a depression or a recession?
Yeah, typically we try to keep inflation at around 2 to 2.5% a year.
Okay.
Uh, there are more things than just the rate getting up to call it a recession or a depression, but hopefully we are far away from a depression. Recession is always very scary to people when we say that word because they hear the Great Depression in their head. But we go in
Hmm.
and out of recessions often, and sometimes it is a way for the market to pull back and put us back on our feet. It's never pleasant. Nobody likes it, but it's sort of part of the natural flow of things. We have recessions a lot. Sometimes they last a few months and nobody even notices. Sometimes they
Okay.
last years. Yeah.
Well, let's talk more about this coming up, and much more I know. But first, I want to get your phone number.
Of course, it's 413-773-3333.
All right, and coming up, we'll have part two of Financial Fitness with the Money Doctor, Dr. Francis Rahaim on WHMP.
Financial Fitness with the Money Doctor is underwritten by Franklin County Technical School. We build futures. Visit fcts.us or call 413-863-9561.
Welcome back to Financial Fitness. I'm Jess Tyler, along with the Money Doctor, Dr. Francis Rahaim. Hi.
Hi, Jess. Are you hanging in there with me?
Yeah, it's big topics today, but this is very helpful, like equating it with your regular credit card, and it makes sense in my head when you do it that way to me.
I hope so. I think that it's important, very important for Americans to have a grip on what's really going on. We tend to hear little sound bites on the news and we repeat
Hmm.
them. And, I'm guilty of it as well as anybody. I've said for years, if China calls our notes, we're done. And people always agree with me. Oh, yeah. But I wonder how many people really know what that means, right?
Yeah.
So, so when we talk about the debt, the tariffs, the idea that President Trump wants to have the Federal Reserve push those interest rates down from 4.25% to 1%. I can't stress enough how drastic a move that would be. Typically, we drop by a quarter of a point. When we drop by a half a point at a time, people get a little twitchy. Dropping by
Well,
3.25 points is like catastrophic. Yeah.
again, I know we talked a little bit about this in the first half, but if you can explain to me again or add on to initially when you hear that borrowing rates are going to be cheaper, it makes you happy. So I know you said there's a lot of risks involved with that. So yes, you still owe the same amount in debt. I get that part. What other things though should make us concerned? Because really, I
Sure.
think most people are going to be like, "Oh, it sounds great."
Yeah. So, right. Why would that what's the risk in that, right? The government gets a lower rate to issue new debt at or buy or pay off old debt, right? They refinance at a lower rate. This is a
Hmm.
thing that Trump used often in his own businesses, and many of us have. You have some debt that you owe, it's at a higher interest rate, so you refinance it at a lower rate. But you probably are aware that most of the time when you do that, things change. All right. If I were
Hmm.
to give you an analogy of a mortgage, for instance, yes, you can refinance it at a lower rate, but you're going to start paying interest at the top again, right? All your interest is front loaded on those loans. So you go back to that clock ticking all over again when maybe you were really chipping away at the debt in the first place, right? If you had your
Okay.
mortgage 7 or 8 years, there may be a fee for refinancing it, and it may affect other things like your credit report. Okay. So you go and you refinance your loan, and a year later you want to do it again, you refinance your loan again. If there was just a human looking at it, you could say, well, I did it because I got a lower interest rate. But the fact of the matter
Hmm.
is, the credit reporting bureaus, or in the case of the country, the credit agencies, are looking at that in terms of risk. Why are they pushing interest rates down? Why are they refinancing? What is going on? And so
Okay.
they look at that and they do what they've just done. All three credit agencies have downgraded. I get the willies when I say it, have downgraded the United States. I don't think we've been downgraded. S&P 500 downgraded us in 2011, I think, when there was a fight over the debt ceiling, right? But all three now, Moody's, S&P, and Fitch, have all downgraded the US. So, for instance, in your credit report, if you saw that your score went from 750 to 620, that means something to you. And one of the things it means is you're going to have to pay more to borrow
Hmm.
money if you can qualify to borrow money. That's not
Right.
a position we want to be in my opinion. We don't want to be in a position as a country where it's more expensive to borrow and more difficult to borrow, right? In
Yeah,
other
for
words,
sure.
where we're talking about those US Treasury bonds that people buy, right?
Hmm.
That is what our debt is. Who wants to buy a US Treasury bond from a company or a country, excuse me, that has just been downgraded, right? You're taking
Yeah.
more risk. And the whole point of you buying those bonds is to mitigate your risk. So that's where I'm at with, what could happen here. Now, what does that mean in your pocket?
Hmm.
It means that cheaper borrowing could make prices worse. Okay, here's another analogy. a regular old world, we all know how to do this analogy. Okay. If you have lower interest rates, we make them available to everybody, right?
Hmm.
It's easier for you to borrow, which
Right.
means you spend. So more people spending money increases the demand. You've got a a store with 10 TVs
Hmm.
and 30 people want them.
Yeah.
They're going to bid each other up. Okay.
Yeah.
The same thing is concern about the country, but for our pocketbooks, that means that could the lower prices could drive inflation up. It's called demand pull inflation, right?
Hmm.
So that's kind of a scary thing because that's exactly what could be happening here. And we also talked just about short term. He's asking for them to drop the short term rates. But at the beginning of the show, I said, beware because your long term rates could be going in the opposite direction,
Mm.
right?
So what's happening there?
So short-term rates are directly affected by the Fed. They move very quickly. When the Fed says we're going to change the rate on short-term interest, they're going to, your car rate or your one-year loan is going to change almost instantly. They're
Okay.
very fluid. Long-term rates, things like mortgages, for instance,
Hmm.
those are based on how investors feel about the future
Okay.
because they're looking at 20, 30, 15 years out or whatever. That's a completely different situation. So sometimes often when the Fed drops the rate, short-term rates go down, but long-term rates can either stay the same or actually go up. So,
And
so
not
you,
good. And so okay, so then that leads to less people buying houses or buying things long term, right?
right, right. And so if we do this long enough, poorly enough, this could lead to stagflation, right? Which
Okay.
is
What does stagflation mean?
stagflation is when the economy sort of stagnates, right? Our job situation is getting a little weaker right now. If we have high inflation and low employment, right,
Hmm.
we're stagnant. We're just sitting there. So stagflation is due when you get that high inflation, but nothing else is keeping up with it.
Mm.
And it's a scary term. Yeah, a little bit.
So I know things are changing minute by minute all the time with the news, but when do we know whether Jerome is going to make this decision or not? Trump is pushing for it, right? But that doesn't mean it's happening.
That doesn't mean it's happening. That's right. And I think it would be really astonishing to see Jerome Powell do this. I mean, I might see him push to a 0.5% or maybe even 0.75% drop over a period of time, sequentially quarter, 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 something like that.
Hmm.
But I think what's really on the table here is whether Jerome Powell is going to be the one making this decision or not.
Okay.
Who will his replacement be? How will what relationship will Trump have with that replacement? Will they be put in place simply to get this done? Uh, but so, when we zoom out from this, Jess, because I don't want to make this a political conversation. There's no way to avoid talking about the government when you're talking about what's going on here.
Hmm.
But whatever somebody's political preferences are is up to them. I'm just trying to get people to understand the money part of this, right? When you
Right.
zoom out and you look at this, and you think about uh, the fact that we don't live in a bubble here in the US, right? It's a tiny little world now. Everybody's connected.
Hmm.
If it hits the news wire that the Fed of the US government dropped a rate overnight from 4.25, or even over a few months period, from 4.25 to 1%, in my opinion, it will be a self-fulfilling prophecy. In other words, we may not be in an emergency situation, but it
But
will
then we
look
will,
as
because
though, yeah, it will look
people
as
will
though
panic.
yeah. I mean, it will look as though somebody behind the scenes knew something catastrophic was coming and they were trying to prepare for it. And then
Right.
it will have that domino effect, that ripple effect, right? You think of a run on the bank when that movie, It's a Wonderful Life, that old black and white movie,
Hmm.
It's a Wonderful Life. As soon as word gets out that there's, a run, somebody's concerned about the bank,
Hmm.
then people panic and they start doing that. And that's the kind of thing I worry about when you see this sort of move, right? I just, I just want to drive home this point about debt again, I think, briefly, because I want the reason I'm talking about this is I think it's so valuable for the average person, everybody,
Hmm.
right, to really understand what the heck this means, not just the little soundbite of if the rates drop, I might have to pay more for gas, but
Right.
how this government is running and what the Federal Reserve decision means and whether they should just agree with Trump, not agree with Trump, why, right? So here's a human example. Imagine you make $60,000 a year,
Okay.
but you've built up $300,000 in debt. Now I know you're saying I'd never have $300,000 in debt on 60,000 a year. You might
Probably
because you
from a
bought,
mortgage and cars and stuff, right?
that's right. And that number, those examples are not that far out of whack when we're talking about the United States debt, right? In relation to what we bring in, the amount of debt we
Hmm.
have is so enormous, right? So instead of paying that debt down, you just keep rolling it into new loans, lower interest rates. You know, even if you get a better rate, you still have this mountain of debt that doesn't go away.
Hmm.
If rates rise again or your income drops, you're in big trouble. Now, the government is not immune to those two things. Rates rise and income drops, right?
Hmm.
It's so parallel to your household finances, but it never sounds that way when they're talking about, whatever the generic financial terms are that make everybody nervous. It never sounds like that. So, lowering these rates is like putting a little bandage on a giant wound. It might help for a while, but it's not going to fix the real problem.
Hmm.
And
And this is something that's getting pushed now, so it could happen at any time, where it could not.
that's right. It could not. I mean, the reason I did this show is because even if this doesn't happen, I hope
It's,
somebody learned not to be afraid of this stuff and to look at it as though it were your own household finances and to understand what
yeah,
that debt really is. The debt is really the treasury bonds that the US sells that other people are buying to mitigate their risk. So we need to look and behave like a safe haven, or we won't be able to do that. And
yeah.
it's a downward spiral from that point.
I,
Yeah,
I think breaking it down to like your household, it does make it so much easier to understand. So thank you for doing that for sure.
I hope so.
All right, let me get your phone number.
Sure. It's 413-773-3333.
And you can go to hugyourmoney.com. We'll be back next week with another edition of Financial Fitness with the Money Doctor, Dr. Francis Ram on WHMP. Thank you.
Thank you, Jess. Will you help us spread the word about financial fitness? Please like, subscribe, and choose all. Thank you. Financial Fitness with the Money Doctor is underwritten by
Hug your money, it's where you belong. Your future's waiting, steady and strong. Dignity shines in the smallest stream. Permission granted to chase your dream. Mission